Welcome everyone to today's session of Managing Your Finances During Cancer, led by Rick Fingerman. This program is hosted by the Blum Resource Center. Over at the Blum, we are grateful to Rick for this continued partnership. The recording of this session will be posted on our Blum YouTube playlist and our Blum Digital Resource Center. For those of you watching live, if you have any questions during today's program, please feel free to utilize the chat feature throughout the session. At the end of the session, your questions in the chat will be used to moderate the question and answer. If you have any other questions or would like more information about resources and programs offered through the Blum, please visit our website at www.dana-farber.org/resource center or email us at blum_center@dfci.harvard.edu. Thank you all for joining us. I will now pass the workshop over to Rick.
Thanks, Sierra. Welcome, everyone. This is another in our series of webinars on how to manage finances during cancer treatment. And just as a heads up, if any of you have any questions after watching the webinar, you can contact me personally. You can put something in the chat as well, and Sierra will see that and pass it on to me. Let's see what we got here. So just a little background. So for those that don't know, Dana-Farber has a program called the Dana-Farber Pro Bono Financial Coaching Program, which is a mouthful, but that started back in 2008. That's me in the middle, a younger version holding a little trophy that we won. Any proceeds that we win get donated to the Patient Assistance Fund at Dana-Farber. So we're always looking for new opportunities there. And this happened back in 2008 when we first started this program. We're up to over 600 families that we've helped and growing. So if you need help or know someone that needs help managing anything from debt to estate planning to Social Security, bankruptcy, anything really, just reach out to your social worker or resource specialist at Dana-Farber or contact me directly, and we can get you some help at no cost to you. Just a quick disclaimer, this webinar is strictly just informational purposes only. It's not meant for specific legal or tax or investment advice, anything like that. But if you have specific questions, again, feel free to reach out to me and I can try to help or get the answer. So we did a FAQ a while back. This is kind of part two. These are questions that come up from patients from time to time, and we thought we would just share them with you as they might apply. So here's one. I've been denied a credit card. What can I do? Well, who knows why you were denied? So one of the first things you want to start with, and this is a good idea even if you're not denied for credit, because this is a way to see if there's any errors on your credit report. This is the only true, free, legitimate site called annualcreditreport.com. There's other ones out there that might say .org, might say .gov. Those are not the official ones that are truly free. And when you log in there, you can actually get a credit report from one or all of these, Equifax, Experian, or TransUnion, which are just credit reporting bureaus. And you can do this as many times as you want. They changed the law during COVID. So it used to be an annual thing, but they're not changing the name. But you could go in there monthly if you wanted to, if you had the time and the wherewithal to check to see if anything pops up. But you will find things on there potentially that are just incorrect. It could be credit cards or credit that doesn't belong to you. So the first step is looking at that. It will not give you a credit score, but it might give you an idea of why you were denied, because the report will show you like how much credit you've got outstanding, things like that, if anything's in arrears or has late payments on it. And if those are incorrect, you can get those corrected. Oh yeah, we get this one all the time. I've heard these 0% credit cards should be avoided, and why? Well, some of you might know of these cards. You have a credit card right now, for example, you charge stuff on it, there's an interest rate applied that could be anywhere from 12 or up to 30% that you pay on this. So they've come up with these zero interest cards that you can transfer balances onto for a period of time, usually 12 or 18 months, and you have to still make the payments, but it's at zero interest. The caveat is you pay a percentage of the balance when you do this transfer. I think I've got this on the next screen. Yeah, so it's 3 to 5% charge on the balance that you transfer. And also on top of that is once that period, that introductory 0% thing goes away, these rates can jump up to 30% legally. It's ridiculous, but and then you're really kind of in trouble. Or if you miss payments, it could jump up to that higher rate too. So you really want to be careful with these 0% cards. let's say you have $5,000 on a credit card and you know for a fact that you can pay this off within that period, then it could make sense to transfer it over there if you're paying, over 20% in interest. But, you can pay it off in under that period of time. I have run into more people that have done this and have not paid it off. And then we're looking at these really high interest rates, which could be much higher than they had initially. So you want to be careful with these. We also have an affiliation with a credit counselor that can help you if you have credit cards and you're just really having trouble managing those and navigating all that. How do I create a budget? Well, I don't even really like the word budget because it sounds very restrictive. And I feel that everybody needs to have some kind of spending plan. Let's see what I've got on this next slide here. So really what you want to do is just list all of your income. So that could be from working if you're working. It could be from Social Security if you're on Social Security, whether it's retirement or disability. Maybe you're getting some kind of rental income, whatever it might be. You want to kind of put that down in one column. And then you want to track all your spending. And there are spreadsheets and there's all kinds of budgeting tools out there. Anybody that wants kind of a nice spreadsheet that adds and subtracts all this stuff for you, I can provide you with that we give to patients. You just kind of type it in there. You don't need a calculator. It adds it up and subtracts it out. Ideally, we want to see the income higher than the expenses, but that's not always practical. So then we want to look at areas that we can reduce. And that consists of really two things. We have, fixed expenses and variable expenses. And sometimes people mix these up. The fixed ones are pretty easy. So a fixed expense is something that just doesn't change. It could be your rent or your mortgage payment or a car payment, where variable expenses, they change all the time. It could be, what you pay for groceries, going out to dinner, gas and oil bills, things like that. You don't have a whole lot of control over utilities unless you just turn the thermostat down and shut the electricity off. But those things are variable because every month they're different. So in the winter, your oil bill, your gas bill is going to be way higher than it is in August. Sometimes you can do a plan with the provider and spread those payments out more equally during the year if that's easier for you to budget. Because sometimes, on Christmas morning, you don't want to get a $400 gas bill. That's not a good feeling. So you can spread that out so your August payment, instead of being, $48 might be 110, but then it's 110 in December as well. So that's just something to be mindful of. We can't really change those fixed expenses too much. If you do have a car payment that's, that's coming due, that's going away rather, that's a good thing because now that money can be allocated to something else. But generally rent and mortgages and those type of expenses, insurance, they're just constant, fixed expenses we can't do much about. So that is the main difference. We get this a lot. Dana-Farber does a fantastic job in providing resources to people for things like housing and transportation, food, and all the things that are out there. And I've come across a few things I've recommended over the years. One's called helpsteps.com and the other is benefits.gov. I think the helpsteps.com has an app too, which is pretty good. And you just put in your zip code and it'll bring up all kinds of stuff. Everything from, food banks to, utility, help with payments on that, to housing helps, things like that. So definitely check out these helpsteps.com, benefits.gov. There's all kinds of stuff in there. You might find something in there that's going to save you some money. Where can I get help paying credit cards? Well, again, if you are struggling with like multiple cards or just making that minimum payment, American Consumer Credit Counseling, here's their website and their phone number. This is at no cost to you. Where they'll help you put a plan together to kind of whittle that down and take care of that and maybe even negotiate with some of the credit cards out there to get those interest rates down and your payment down. So that's a good resource as well. Oh yeah, we got this a little while ago. So this person needed a card to get to work. They just had a type of job. They couldn't take public transportation based on the hours of the day and all that stuff. But they didn't have a lot of money. Anybody that's gone out to buy even a used car today knows how crazy these prices are. So there's an organization called secondchancecars.org that aligns you with some nonprofits that have cars. If you meet the requirements, that you can get into a car for a whole lot less money than you would if you went to a dealership for sure. So secondchancecars.org is that one. Here's one. I'm on a Social Security disability as a way to have my student loans forgiven. There's been a lot of talk in the news over the last couple of years with loan forgiveness, and that has worked for many people. We've helped a lot of clients with that ourselves here. But federal student loans is one of those things that, generally speaking, is really hard to get rid of. You can't get rid of it in bankruptcy. They're pretty much stuck with those unless there's some kind of loan forgiveness. But if you are truly disabled, I think I have a definition here. And this is for federal loans only. So if you are totally and permanently disabled, and generally if you're on Social Security income, SSI or SSDI, Social Security Disability Income, you may qualify to have this loan forgiven. And here's the site. I don't know if you can actually cut and paste this if you come back and look at this webinar later. But you could also just Google, permanently disabled federal student loan forgiveness and see what pops up. But definitely go for that if that's an option. We've had a few experiences with this too. I have a life insurance policy, but I can't afford the premiums, but they want to keep the policy so their family gets something if something happens. Is there anything I can do? And there are a couple of things. So one is you can lower the death benefit. So let's say you have a $500,000 death benefit on a life insurance policy. You can contact the company and say, I want to reduce my benefit to, let's say, $250,000, and that will reduce the premium. Not exactly in half, but generally it's half of whatever it was. You want to be really careful before doing that, though, because once you reduce that benefit, you can't increase it again later on. You can't, if your situation changed, you can't go back and say, yeah, can you put it back to 500,000? You can always go down, but you cannot go up when it comes to life insurance, because then they want to see insurability, medical stuff, all kinds of things, and they probably will deny you if you're in treatment. So be careful with that, but that is an option. The other option is to sell the policy. There's something called a viatical settlement. And there are companies out there that will, let's say you have $1 million life insurance policy and you're terminal and you need some money today. They will buy that policy from you. They may give you, $600,000 or $800,000, whatever the number might be, that you can use today. But again, you want to be careful with that as well, because once you sell that policy, you do get the cash, but the death benefit goes away. But it's a way to, get some money today. We had a client a few years ago. They had 2 life insurance policies. So we did a viatical settlement with one of them, and then we kept the other one. So they got cash up front on one, and the other one had the death benefit because their premium went away when they sold it to the viatical settlement company. Let's see. My cell phone bill is crazy, but I need a phone. Are there any cheaper options? Well, there probably are. I know I feel like I pay a lot for my cell phone. It's just a Verizon cell phone, but there's a company called SafeLinkWireless.com, and that can provide basically a phone at zero cost with a plan if you meet these certain guidelines. So again, if you're struggling with a really expensive cell phone, and these are actual smartphones, so you can use them to get an Uber or whatever. They're not like some little flip phone. Check out SafeLinkWireless.com. That is an option that might be worth looking into. Oh, questions for me? I guess that's it. So I don't know if any questions came in, but we can answer that. If you have any, you can share those with us in the chat box, and we'll be happy to try to answer those.
Awesome. Thank you so much, Rick. We do have a few questions that came through, so I'll just kind of go down the list and read them off.
Sure.
The first one is it better to pay my credit cards off or put the money in savings?
That's a good question. So if again, if your credit card is at 20 or 30%, it's probably better to pay those off than put it to savings, because that interest rate usually kills people where they just can't make those payments and get rid of that card. If your interest rate is lower, or you've got a small balance, maybe you only have 1,000 or so on there, but you've got some savings that you could allocate toward that, and you have no other savings or an emergency fund, I think it's good maybe to split the difference, get some money in savings, because the credit card becomes really a savings account for many people. They need money for food, or if you're at Dana-Farber for the day, you have to get there, you have to pay for parking, you might have to buy some food. If you get your kids with you, there's money there. So the credit card seems to be the go-to place. So that's a really tough question to ask in a general way, but ideally we want to have some savings because we want to use that money before we use a credit card. So I don't know if that was helpful, but Yeah, if you're paying 30%, I would just get rid of that credit card as fast as you can. Just pay down as much as you can over the minimum payment.
Awesome, thank you.
Sure.
The next question is, I have money in a Roth IRA. I was told I can take money out tax-free even if I'm not retired. Is this true?
Maybe. So here's the way the Roth works. So Roth IRA is money that went into a retirement account after taxes. So you pay tax on that money, you make a Roth contribution, and that money goes tax-free. And when you take it out in retirement, it's all tax-free, 100%. But a couple things have to apply. For you to be able to take all that money out, you've got to be at least 59 and a half, and the account has to be open for at least 5 years. However, you can open a Roth IRA today, and it doesn't matter what age you are. You can be 12 years old if you have earned income. You put in, let's say, $1,000 into your Roth IRA. You could take the $1,000 out the next day. There's no penalty, there's no tax. It's only the earnings on the Roth that apply to that age 59 and a half and 5 years old account requirement. But as far as the original principle, so let's say you put in $1,000 a year over the years, you get $10,000 in there, but it grew to 12,000. You can take your 10,000 out, leave the 2,000 in, no problem, no tax implications, no worries. But that being said, retirement money like Roth IRAs, regular IRAs, 401ks, they're really designed for retirement. But, we certainly understand that circumstances happen in life where we have to pull money from. But before you pull money from a retirement account, it is best to speak to somebody, a certified financial planner or somebody in this program, because once you take it out, it's a little tricky to get it back in if you ever wanted to do that.
Thank you. The last question is, my ex-husband just passed away. I was told I was eligible to collect a Social Security benefit, but he was only 62, and I'm not sure if he was collecting yet. And I was told if he wasn't collecting, I had to wait to collect.
And did you say ex-husband? So, so there's a few things here. If you are, ex means to me that they're divorced and the husband passed away. So the rules are kind of similar whether you were married and the spouse passed away, or if you were an ex-spouse and the ex-husband passed away. The difference is if you are divorced, you have to have been married for at least 10 years before you got divorced. If you only married 8 years, then you can't do this. But let's say you were married at least 10, and you are at least 60 years old when because you said your husband was 62, ex-husband, when he died. So as long as you're at least 60 and you're not remarried, that's the other key, then you can apply for a widow's benefit on your ex-spouse. But it gets trickier. So if you collect before your full retirement age, and for people that were born 1960 or later, that's age 67. And if you're still working and you collect before that full retirement age, and you made more than 22,000, I think it's 320 in 2024, then there's something called the earnings test applies. So they look at your employment income, and if you made more than that 22,000, then they can take money back from that benefit. So it might not be worthwhile to collect. The other issue is if even though you can actually collect as early as age 60 on a deceased spouse or an ex-spouse, or age 50 if you're disabled, but that's a whole other thing. But let's say you collected at 60 years old, you're going to get a reduced benefit. You're going to only get about 70% of what that benefit amount is. So ideally, you want to wait till your full retirement age, which would be 67 people 60 or older. It's a little younger if you're born before 1960, because there's no reduction. You can keep working. You can make $1 million a year. The earnings test doesn't apply once you hit that full retirement age, again, of age 66 and 8 months to 67 for most people today. I don't know if that answered that question, but you can't be remarried before age 60 on the ex-spouse deal. So if Social Security wasn't confusing enough, but anyway, yeah, that's the story.
Awesome. Thank you so much, Rick. I think that's all the questions that we have for today. But I want to thank you again for your time and always giving us these great presentations that are truly so informative.
Yeah, and if anybody, I'm sorry, I didn't mean to interrupt, but if anybody has any questions, they want to contact me personally, my email is down here below. I'm happy to reach back out to you and see how I can help.
Awesome. Well, thank you so much, Rick. And just as a reminder, this was recorded and it will be posted on our Blum YouTube playlist and our Blum Digital Resource Center. So thank you again, Rick, and thank you all for joining us.
Thank you.